Integrated reporting. This is a topic that's becoming more and more relevant and more important as not only are more companies started to move in towards this area of integrated reporting, but more and more users of financial statements, more and more stakeholders are interested in seeing a little bit more than just the financial information of a company. And so what we're talking about with integrated reporting is not only the financial statements, but a report that incorporates non-financial information as well as the financial information that's provided in our normal standard financial reports that we're used to. And so by getting this non-financial information, the users of those financial reports, the companies are preparing and using more information to make their decisions. It's not just what was the profit or loss for this period. It's not just what is the carrying value of our fixed assets. But as we see, we're going to be looking at what are the capitals, the different types of capitals that a company uses. What is it that they're doing with those capitals? How are they using them? What's their business process, their business model? And how is that hopefully increasing the amount of capital that the company has? And also, what are they doing that is going to allow them to continue to do this, to continue to be successful, not only now, but in the short, in the medium, and in the long term as well? What is the company doing, not just about its financial statements, but kind of its overall reporting, financial and non-financial as well, how it's operating its business and how that's going to work going forward for the company. Now, this whole issue of non-financial information, this whole idea to look outside of just the financial statements, well, this is kind of connected to corporate social responsibility and sustainable development. And as these terms and these ideas have become more important to more and more stakeholders, investors and customers and suppliers, there's a greater need for information that addresses this. There's more need for the information that's outside the scope of the financial statements. And so that's what we're looking at with integrated reporting, is providing more information than just what it is that is in the financial statements. Now, if we kind of look at how this developed, ISO 26000, Guidance on Social Responsibility, this helps organizations structure, evaluate, and improve their responsibility, or their social responsibility, but it doesn't give that guidance for reporting for it. And so according to ISO 26000, the social responsibility, this definition of it is, social responsibility is an organization's responsibility for the impacts of its decisions and activities on society and the environment through transparent and ethical behavior that contributes to sustainable development, including the health and welfare of society, takes into account the expectations of stakeholders, complies with applicable law and is consistent with international norms of behavior, and is integrated throughout the organization and is practiced in its relationships. It's not just something that one or two people do, but it's throughout the organization. It's connected in all those relationships that the business has with people inside and outside the business. Now, as I said, ISO 26000 gives guidance on how a company can be socially responsible, but it doesn't provide that framework for reporting on its social responsibility, to communicate how it is that it's doing that. And so there was a need, therefore, to come up with some reporting frameworks for this. The earliest framework for reporting on social responsibility and sustainable development was introduced by the Global Reporting Initiative, or GRI. Their first reporting guidelines, called Sustainability Reporting Guidelines on Economic, Environmental, and Social Performance, were launched in 2000, and it's been updated several times since then. And this GRI framework has become kind of that international standard for reporting on environmental and social responsibility, sustainability, and economic performance. Now, the United States as a country does not have mandatory non-financial reporting requirements, but a lot of companies and growing number of companies are preparing this information voluntarily. And some countries do have requirements. And those national reporting requirements led ultimately to the development of the International Integrated Reporting Council, okay, the IIRC, the International Integrated Reporting Council. And their purpose is to create a globally accepted framework for a process that results in communications by an organization about value creation over time. Okay? value creation over time. And the International Integrated Reporting Framework was published in December of 2013. Now, we've got just kind of some background here about the IIRC. We'll look here at their mission, their vision, and their objective. And I think this kind of sets the foundation for what it is that we're looking at here. So their mission is to establish integrated reporting and thinking within mainstream business practice as the norm in the public and private sectors. Okay, their mission is for this to be normal. Now it's not. Okay, now this is kind of unusual. Oh, wow, look at this report. But the goal, the mission here, is for this to become the norm. Their vision is to align capital allocation and corporate behavior to wider goals of financial stability and sustainable development through the cycle of integrated reporting and thinking. Okay? Put this all together, integrated reporting, integrated thinking, and we'll look at those definitions here in a little bit. Their objective is to change the corporate reporting system so that integrated reporting becomes the global norm, which means at some point in the future, instead of getting the financial statements that only has the balance sheet, the income statement, and the statement of cash flows, that normal reporting process is going to include non-financial information as well. It's going to look at different aspects of all of this, how it is that the company is operating. Okay, but this is what they're trying to do. They're trying for this to become normal. Okay, this thought process, thinking about it is normal, and the reporting for it is normal as well. Now, that International Integrated Reporting Framework introduces the concept of reporting non-financial information as an integral part of the annual report that can be read by all stakeholders. Okay, so again, putting this into that annual report that the company issues, this is going to be part of it. Now, there's a specific definition of stakeholders that the IIRC uses, and we'll read that right now. Stakeholders are those groups or individuals that can reasonably be expected to be significantly affected by an organization's business activities, outputs, or outcomes, or whose actions can reasonably be expected to significantly affect the ability of the organization to create value over time. Stakeholders may include providers of financial capital, employees, customers, suppliers, business partners, local communities, NGOs, environmental groups, legislators, regulators, and policymakers. That's a lot of different stakeholders, a broad definition of who a stakeholder is. Okay, it's not only those who are affected by the organization, but who are going to affect the organization. The ability of the organization to create value over time. So it's not only going outward, but it's coming back into the organization. Stakeholders are anyone who's in a position to affect the ability of the organization to create value over time. And what we'll kind of wrap up our introduction here with are just three definitions, just kind of as, again, a foundation to what it is that we're looking at. Integrated report definition: a concise communication about how an organization's strategy, governance, performance, and prospects in the context of its external environment lead to the creation of value over the short, medium, and long term. Okay? Short term, medium term, and long term. Creating value. Okay? Strategy, governance, performance, and prospects create value. Okay? See these terms? We're going to come back and see these terms a little bit later as well. The definition of integrated reporting: a process founded on integrated thinking that results in a periodic integrated report by an organization about value creation over time and related communications regarding aspects of value creation. Okay, that's that reporting, value creation, okay, how that is being done. Now, integrated thinking: the active consideration by an organization of the relationships between its various operating and functional units and the capitals, and we're going to talk about capitals, that the organization uses or affects. Integrated thinking leads to integrated decision-making and actions that consider the creation of value over the short, medium, and long term. So, how many times have we seen it here now? Creation of value over the short, medium, and long term. Okay, so that should be in your mind now as something that's kind of a key element to this. What we're looking at in terms of creating value over the short, the medium, and the long term. And we're trying for this concept to be part of how it is that a company operates. It's part of their culture. It's part of who they are. It's not something that's done, the first Tuesday of the month or something like that, but it's naturally incorporated into what it is that the company is doing. If we get this non-financial information as part of the decision-making process, we'll get better decision-making. Okay, we're going to have better decisions. We're going to have more successful companies by looking at more than just that financial information of the company. And so this is this whole idea of integrated reporting. We've kind of laid the foundation, and what we're going to look at next is we'll turn our attention to the different types of capital that a company has and kind of that value creation process that a company has, which clearly we've seen it a number of times here. And so that value creation is what's important, and that's what we'll look at next.